Natasha. Hello. Good morning. Can you hear me?
Yeah.
Right. Okay. Right. So we were looking at some of the transfer pricing questions, but we could not complete the whole thing. So you can look at some of those questions also. I want to go into a new area actually, which I should have covered up earlier. It's all about the return on investment, residual income, the various performance measures for responsibility centers. So today let's look at that one, because later on we will look at some more questions on all other areas.
Okay.
Nice. What are the questions in the transfer pricing? See whether you can do it. If you whether you can do it or not, try it. And if you have any difficulties, let me know or send me the answers. Then we can go through and see how it is. Okay, so let's look at some of these what we call performance measures and control. You remember we were talking about the budget. The main tool to manage the responsibility centers is to give a budget, to set certain targets and to see whether they achieve those targets. Whether it's organization, whether it is the government, that's how they try to see whether they have achieved what they planned for. If they are not achieving what they are planned for, or if they feel that they are not going to achieve what they are planned for, or if there is some kind of information that is saying that they are not going to do, that is what we call risk. And that we need to manage it. And that is what you will find it in P3 paper, all about the risk management. But let's talk about little bit about the budget. So we have discussed some of these areas. Basically, any organization should have targets, whether it's a responsibility center, whether it's a separate company, a group of companies, a government, whatever, they must have certain targets, and targets should be expressed in some way. You remember we were discussing some of the financial targets, and also we were discussing some of the non-financial things like customer satisfaction, etc., etc. So basically there are three items. We have discussed this earlier: profitability, liquidity, assets turnover. Profitability really reflects what is the kind of profit what we are getting by doing this activity in terms of sales, how much profit margin we are getting, how much contribution we are getting. All that is very important for us to know, exactly the way that we are going forward. So that's what we call profitability. Liquidity, as you know, is a very important tool which we have to manage on a day-to-day basis. Even if it is not profitable, we must be liquidity. We should be able to pay our salaries on time. We should be able to pay our suppliers on time. We should be able to pay our taxes on time. If we can't pay any of those things, even if we have big profits, we may be in crisis. So there are some companies who are making big profit, but they cannot meet their immediate day-to-day requirements because they have big buildings, they have big property, plant and equipment, but they don't have money even to pay the day's salary. So that's a crisis. So it's essentially I would say it's not a short term, it's an ongoing one to manage the liquidity. That is why we have to have rolling cash flows, cash forecasts, etc., to know how best we are doing it. Third one is what we call the asset turnover. It reflects how well we are managing our assets. Because with the money that we get from shareholders, with the money we get from our lenders, what we do is we go and invest in assets. Property, plant and equipment, commonly called non-current assets, and also some current assets like inventory, some like receivables, some also we keep it in form of cash. Whatever the assets what we have, it should not be excessive assets. It should not be a wastage, because all the money we get from the lenders, all the money we get from the shareholders, we have to pay a return to them. For the lenders, the return is in form of interest. For the shareholders, the return in form of dividend. So money is costly. Money is not coming free. So we need to pay a return, and therefore we must invest all our money wisely. So that is what the asset turnover ratio will tell us, how wisely a company has invested its money. So basically it's asset divided by turnover or asset divided by revenue, which says per dollar of revenue, how much assets we do have. So that's the kind of a thing we should be looking all the time. So senior management should be setting certain targets, and the budget must be prepared wanting to achieve those targets. If you can't achieve those targets, then your budget is not approved. If it is coming through a participatory method, the budget committee, the board of directors will reject the budget saying, no, sorry, we can't approve your budget because you are not achieving the target. So the management must set certain targets. Of course, the targets, as I said earlier, should be something challenging, but it should not be too difficult. I mean, if it is something which is not achievable, people will not get motivated. If it is very easy also, people will not get motivated. So it should be stretched beyond, little excess kind of a thing, so that people will have to work little bit more harder. People will have to think more in a more new way. Because if you set the old same targets, people will not be using their brains, people will not be using even their common sense, and the things will not happen. This is what our case study is all about. Case studies, the companies are doing all right, but we want to do something better. So the case study is how to do better. How can we anticipate the problems that we might come across and trying to work through that one. So basically the three ratios very important: profitability, return on capital, profit margin, and asset turnover. And I think we discussed this one earlier. Return on capital is equivalent to profit margin times asset turnover. Return on capital is equivalent to profit margin times asset turnover. So every company should be trying to improve the ROCE. The way to improve ROCE is to increase the profit margin. The way to increase the profit margin is to have good cost control or good cost understanding of good cost behavior, and trying to work through the cost structures. And asset turnover is to see that we invest our money wisely in right assets and not to have any excessive assets. That's what the asset turnover. Not excessive assets, not even low assets. I mean, if you don't have enough assets, then you can't do the business. You may have big capacity to generate revenue, but you don't have enough assets. So you can't do it. So it should not be too low. It should not be too high. It should be something which is achievable, manageable. So profitability can be discussed in terms of profit to sales ratio, which basically tells us for each $100 or each 100 rupees, what is our profit we get. So higher the profitability ratio, higher the profit margin ratio, it's good. The other ratio that can be, instead of profit, we can look at contribution. Obviously, you will agree with me, the contribution margin will have to be much more than the profit margin, because the contribution need to cover the profit plus fixed overheads. Contribution means sales minus variable cost, and that contribution should be good enough to cover your fixed cost plus the profit. So that's what we call contribution margin. Senior management will set up minimum targets for profit margin, and they will say, if you are not going to get it, we are not going to approve the budget. So I was working in a company, I always used to tell them, you must get this profit margin if you are importing a product. If you don't get that profit margin, we will not approve your LC to import the product. So that's the way people set up the target. So three profitability: return on capital, profit margin, and asset turnover. And as I said, the ratio number 1 is equivalent to ratio number 2 into ratio number 3. So sometimes in your short questions, you might get this kind of a question. They might give 1 and 2 and ask for the 3, or they might give 2 and 3 and ask for the 1. So we must know ROC is equivalent to profit margin times asset turnover. So ROC is equivalent to profit margin times asset turnover. This last line is very important. There will be 1 or 2 questions in this area in your paper. So liquidity, as I said, is basically having cash or ready cash. That's what we call in our IAS 7 cash and cash equivalents. We must have money to pay our things, whatever that we need to do. And also if we don't have money, we must have at least cash equivalents. Cash equivalents are something what we have put in call deposit, which we can withdraw very quickly and which can be converted into cash without too much of a change in the value. So that is why gold is not cash. Right? Gold is not cash because when you convert gold, the value can change. Shares are not cash and cash equivalents because when you convert, even though they are liquid, it may not get converted into the same value. The values can change. Value can increase, value can be less. But if you put up a short-term deposit for 3 days or 6 days or 7 days in the bank, you almost know you will get the same value, and that's what we call cash and cash equivalent. So basically that is what we call, you remember there are things called current assets, inventory, receivables, and cash. There is a purpose why we keep cash. Cash itself is useless because if you just keep money in your current account, if you just keep money under your pillow, it's a useless commodity because it is not going to earn any interest, any earning. Cash must be invested. Cash must be invested in non-current assets. Cash must be invested in even in other current assets like inventory, receivables for cash to become useful. But we know, all of us, we need to keep some cash in our account for an emergency. So there are 3 reasons why we keep cash. One is what we call transactions motive. Transactions. So this you would have learned in your P1. Transactions motive. The idea is we need cash to make certain transactions. You have to pay your water bill, you have to pay your electricity bill, you have to pay your telephone bill, you have to pay your salary. You can't show your employees, look here, we have a big building, so don't worry about cash, you work. You can't tell your electricity man, look here, we have a big plant, so don't worry, we will pay you one day and keep electricity. No, you need money. So for that purpose, you need to keep money. That's what we call transactions motive. Second is what we call precautionary motive. All of us, we keep little cash for an emergency. Suddenly something might come up. Right, in our families, it can be a sickness that can come up. So we can't have all money invested in houses and fixed deposits. We need to have some money. If we have to get admitted to a hospital, we need to have money. And similarly, businesses also, there will be some emergency things happening. Suddenly, the raw material prices are going up. You want to stock some raw material. So for that, you need to have money. And that's what we call basically for precautionary motive. For an emergency, we must have money. Then the third reason why we keep money is for speculative motive. Speculative motive. That is basically, you see something happening in the market, like in the next 6 months, fuel prices are going up, raw material prices are going up. You speculate, and if you have money, you can stock and keep it. So that's what we call the speculative motive. So there are 3 reasons why keep money: transactions, precautionary, and speculative. Earlier we thought the current assets to current liability should be something below 2, something should be more than 2, and anything less than 2 was considered low. That was in the old age, 1970s, 1980s. Everyone looked at the current assets to current liabilities and they compare that ratio. But today, it is not that for all the industry. Today, this time, the management case study is all about the single price, like this dollar shop kind of a thing. In there, you don't have current assets, current liabilities 2:1. In fact, it is 0.5 or something like that, less than even 1. If you look at supermarkets, it's less than even 1, because most of the supermarkets, they buy the products on long-term credit, they sell on cash. So because of that, they have a big current liability outstanding and they can manage it. And some of these companies like Odell, if you look at, although they have big stocks in that stores, none of their items are their own inventory. Not none. I mean, many of the items are not their own inventory. It is on consignment basis. People come and keep the goods and go. They say, okay, if we sell, we will pay you. If we don't sell, it will be returned back. So you don't need to invest a lot of money on inventory, right? So that's the way some of these industries work, some of these business sectors work. But some industries you need to invest. Manufacturing industry, you need to have raw material. You need to have work in progress. You need to have finished goods. So there you will have a big inventory. So from one industry to the other, one business to the other, the ratios can change, and therefore you can't standardize and say it should be 2:1. Not necessary. Particularly in the service industry, for example, the ratio can be very, very high, right? Because they will not have too much of liabilities also. So that can happen. So it all depends on the particular industry. Then we have another little ratio which we call quick asset ratio, where we looked at current assets minus inventory. So current assets are inventory, receivables and cash. The moment you minus the inventory, that means because the inventory is not something which we can dispose quickly and convert it into money. It takes time. The working capital cycle works. First of all, it is inventory. Inventory should get converted to receivables. Receivables should get converted to cash. So inventory cannot get overnight converted into cash, and therefore sometimes we work out a ratio called quick ratio. Therefore, there again it was thought 1 is the minimum you should have. And generally anything below 1 is considered high risk, bad. But again, you have to be cautious. You must compare the industry. You must see the industry standard and see whether this has any meaning. So ratios should not be allowed to rise beyond a level, because if you have a big ratio like current assets to current liability 3:1 or 4:1, that means you are having excess investment in inventory or excess investment in receivables, which is totally unwarranted. Because any money that you invest in inventory is not going to generate revenue. Any money that you have put on the receivables is not going to generate revenue. Any money you invest in non-current assets, good non-current assets, will facilitate generating revenue. So that is why working capital management is a very key function. It is discussed very much in F1, F2, and you need to get through those things. So we saw the investment centers and performance centers. For normally, for a company, what we call is a ROCE for a company. For a department or a division, we call it ROI, return on investment. So at corporate level, it is return on capital employed, and at local level, at divisional level, it is return on investment. Simply, it is your profit before interest, because for a division you may charge interest, but you take the profit before interest divided by your assets employed, or what we call capital employed. So that's the way we work out for a division the ROI, profit before interest. For a company, it is profit before interest and taxes, what we call operating profit, divided by capital employed. Capital employed is equity plus liability, equity plus non-current liability. But for a division, we can't sometimes find out the total liability because it's at corporate level. So we can't say this is the loan we took for this particular division. So we look at the profit before interest, because there for a division no tax, profit before interest. Sometimes the companies may charge notional interest, but take the profit before interest divided by your total assets employed. So it can be your current assets plus your non-current assets. That is what we call ROI. So ROI is more common for divisional performance. there are a couple of big advantages. It is widely used and accepted. People understand it very easily when you say our ROI is 10%. And it can be used to compare two divisions. Now, for example, you might find one company making a big profit, one division making a big profit, 100,000, but their divisional assets are 1 million. So 100,000 divided by 1 million is 10%. You might find another division making 200,000 profit. So if you look at the profit, that division 200,000 is very big, better than the 100,000. But you might find they are employing 4 million worth of assets. So 200,000 divided by 4 million is 5%. So if you take in terms of ROI, the first division is doing better. They are making 100,000 with a 1 million investment. Second company is making 200,000, but they are taking 4 million of your investment. The bigger the investment, that means the company has to pay more interest, or the company has to pay more dividends. Company has to pay a return to the investor. So you must try and maintain a good balance between your return and your investment. You can't be just going for the sake of profits and making big investment. That's not what is expected of. Right? So the comparisons is very easy because everyone understands, because it's in the same division, same company. So when you say this division is making so much and that division is making so much, that is telling us a story. So we can always get a comparison. But it will lead to some dysfunctional behavior. May not accept low ROI project. Now you and I know any project that is going to bring a return much more than your cost of capital should be acceptable. But for example, let's assume that your division at the moment is making a return on investment of 10%, right? Return on investment of 10%. And you are getting a new project. That new project is going to make a return on investment of 8%. Your cost of capital is 6. So if you just take it on an isolated basis, you should agree with me that 8% project is good because it is bringing more than 6% cost of capital. So let's go for it. But one might argue it and say, the divisional manager will say, no, I'm not going to do that project. The reason being, already I'm earning 10%. But if you bring this new project and put it at 8%, my overall return on investment will come down because already I'm at 10. And if I take this new project, so from the company's point of view, that new project is good because it is going to bring a return more than the cost of capital. So it is going to add more profit to the company. It is going to increase the shareholder wealth. But the divisional manager may reject it. So this is what we call a dysfunctional behavior. And also when you talk about the return, we are talking about a profit. Profit is something which can get manipulated. The reason being, depreciation policies can change, many things can change. So the comparison can sometimes become very confusing because there can be lot of distortions in your accounting policies what we use, and that can create some kind of a distortion and it may not be very, very comparable. Now you remember the return on investment is your return divided by total assets. Now today, let's assume that you have 100,000 return or a profit before interest and taxes, or profit before interest, 1 million assets. So 1 million divided by 100,000 is going to be, I'm going to put some figures here. So ROI is 10%, right? So this is your present situation. And you have to buy a new machine. New machine. You have to replace your old machine and buy a new machine. New machine is going to cost you another 500,000. But just because you buy a new machine, your profits are not going to get increased immediately. In fact, the profit may come down because new machine means you have to provide additional depreciation. So this 100,000 profit can come down to 75,000, for example. Listen, immediately there is no increase because you are just replacing, right? 75,000. But your new machine is now worth 1,500,000. You can see now what has happened to your return on investment. Return on investment has come down to 5%. So the manager will say, I don't want the new machine. I don't want the new machine because when I take a new machine, my ROI comes down. Now, if you look at from manager's point of view, his story is true because if he's paid a bonus based on the ROI, he will say, I don't want it. But look at from the company's point of view. We need to replace machines. We can't go with the old machines all the time. We need to go for new technology, new machines. So, because we are measuring the performance on ROI, the manager may decide to hang on to old property, plant and equipment without going for new innovations, without going for new things. They will hang on to the old. And if they keep on hanging on to the old, what will happen is in the long term, the business will suffer. So it's a question of short-term targets against long-term targets. So when you keep when you keep pressing on ROI, ROI is a once a year, a short-term kind of a thing. So people may look for that kind of a thing and decide, oh, we don't want to go for new machinery. And in the long term, the company will be running with old machinery, which will be disaster. So there can be a situation like that. So these are the problems with using the ROI measurement. So one, we can have certain disadvantages. So one thing we have to remember, whenever we make profit, the profit is made upon by using assets. Assets means we have capital employed. Capital employed means there is money that we have borrowed or we have taken from the shareholders, which has a cost. So whenever we make a profit, we must remember that the profit we are making has a cost in terms of capital employed. So this is what we get it to what we call RI. RI is we look at that profit, the same ROI profit before interest and taxes. So let's assume that we have made a profit of 100,000. 100,000 is the profit. But to make this profit, division A used 2 million of capital. The cost of it, let's assume it is 6%. So this is a notional figure. This is a figure that your finance manager or the finance director will say, this is our notional cost of capital. It may not be the real one. It may be the real one, but it is something which we use it as a benchmark to find out and work it out and say, okay, you made a 100,000 profit. We have used 2 million worth of our capital, and the cost of that asset, what you use, we have to pay 6% interest or 6% return, which is 120,000. Even though you have made 100,000 profit, you have not done very well because when you look at the capital that you have employed and taking the cost, you have ended with a minus 20,000. Let's assume another division. So this is division A. division, maybe he makes a very small profit, 50,000. But his capital is only 500,000. And he is also charged the same 6% because you can't charge a different rate for him in the same company. At 6%, which is going to be 30,000. So 50,000 minus 30,000 is a plus 20,000. So you can see, even though the first man made 100,000 profit, because of his heavy capital utilization, he is bringing a minus 20,000 to the company. Second man, small profit, but it is bringing a plus capital, a plus residual income to the company. So obviously you will agree with me, second man is much better than the first one. After all the hard work, we end up with a minus 20,000. Here, maybe little hard work, 50,000 profit, but we end up with a 20,000 profit. So there are certain advantages. So ROI is one measure we use it, RI is one measure we use it. Both for ROI and RI same profit. The profit we use is profit before interest. So advantages, it reduces the ROC problem of rejecting low ROC projects for the division. So you remember there, if the ROI is something, actually we should not call it ROC, we must call it ROI, and because ROI problem of rejecting low ROI, so presently you are getting 10% ROI, when you have a new project coming with 8%, you will reject. But here you will not do that one, you will look at whether it's a positive RI. If it is so, you will take it because you are measuring on the RI. So RI is getting increased. Even earlier say, now the present RI is 20,000. You are going to do a new project and that is going to bring RI of 10,000. You will take up because the total RI will go up from 20 to 30, which is good for you. So you will take up the new project, right? So you will not reject the project because of the low RI, because it is going to adapt to your present RI and you will take it up. Cost of financing is brought to the attention of managers. Now the managers earlier in the RI situation, in the ROI situation, he looks at 100,000 profit. He looks at 2 million and he will say, hey, I'm getting 5%, 2 million, 100,000, 5% return. What's wrong with me? Because he does not know the cost of capital is 6%. But the RI brings him immediately to attention the cost of capital. So immediately he knows, wow, 5% is not good enough. I need to make 6%. So because the managers should be brought into the attention the cost of capital. This was one of the problems we had it in our earlier days. Most of the managers had no clue about the cost of capital because they were basically the people working, making sales, making production, all that, but they had no idea. They want to buy the best machinery, they want to buy the best cars, forgetting that everything has a cost involved in the capital. But today, that is why everyone is taught about the cost of capital. So one way to taught about the cost of capital or to teach about the cost of capital is to bring the residual income concept into your business. So in the case study, this is the area that most of the time they will be testing us because they want to see whether we can communicate the importance of cost of capital to the residual income concept and the cost of capital to our fellow members or the fellow colleagues in the various divisions. Disadvantages, unlike in the ROI, it cannot make a divisional comparison because you can see here, one division makes 100,000, other division makes 50,000, right? And if you look at in terms of profit, 100,000 is better than 50,000, but in terms of RI, we can see it's worse. So are we to go ahead with small 50,000 project or should we go with 100,000? A difficult decision to make because the comparison becomes meaningless. does not relate to the size of employment of assets in order to obtain that profit, right? Does not relate to the size of employment of assets in order to obtain that profit. So it all depends on the profit what you are going to make, and we have to take the size into the account. So these are the disadvantages in the RI, but RI is also a very, very strong measure. We use it most of the time to calculate the performance. We can see here in this company, small profit, but RI is big. Bigger profit, RI is small. So we can have this kind of a situation which does not tell anything good about the division A or the division B, or rather particularly division A. Something which we have brought up in recent times is something what we call economic value added. Because what we have realized is our old profit concept, which we use, is very, very, what we should say is very distorting, very misleading. Because we have something what we have to look at, what we call the economic profit and economic capital employed. Because if you really remember the figures what I wrote, some of the assets what we are using may be very old assets, and economically they are not worthwhile to keep, but we keep on using those assets because that way we can show a bigger, higher ROI. So now we have brought something called economic value added, which is basically we are trying to see the value that is added to the business in terms of economic value. So it is something but we are linking it to the shareholder wealth. We are looking at all the time, the real value we added to the business, because with the inflation, we know some of the values what we show in our balance sheets may be very misleading. So there are few adjustments what we look at. We take the profit after tax and we adjust it to give what we call net operating profit after tax. Net operating profit after tax. Right. Then deduct economic value of the capital employed. So we don't take the book value of the assets like in the earlier case. We take the economic value of the asset. Economic value. Now, for example, you may have a motor vehicle inside your company which was bought 3 years back costing 2 million, already depreciated 25%, 25%, 25%. It is appearing in your balance sheet at 500. So if you take the book value, it is 500,000, and you might make a profit of 100,000, and you will say 20% return. But we know that is not the economic value. If we want to sell that vehicle today, we are not going to sell it for 500,000. We are going to sell it maybe for 2.5 million. So we have to compare that value, the real value, the real replacement cost, or the real the residual, the real net realizable value. Take that value, because that is your real capital employed. The book value is 500,000, but is it right? No, because we can sell this asset for 2 million. We can sell this asset for 2.5 million. If you want to replace this, we have to buy asset for 3 million. So take the economic value of the capital employed, multiply by cost of capital. So it's same as RI. Instead of taking the profit after tax, we take net operating profit after tax. We do certain adjustments to the profit, and also we take the economic value of the asset. We don't take the capital employed in the normal thing. So it's a RI, a more modified RI, I would say. So net operating profit after tax is NOPAT. So this is the way that we will calculate, and what we get economic value added. So net operating profit after tax is simply you take the profit after tax and you add all non-cash items such as depreciation, bad debts, because all those are book entries what we have provided based on certain arbitrary accounting methods we are using. Add all those. So add all the interest paid, because we are looking at profit before tax, but we take the profit after tax at the interest paid net of tax, because the profit is always the interest is deducted before taxes. So when we are taking profit after tax, we must add the interest but net of tax. So that is interest times 1 minus T. T is the tax rate. Then add value adding items, goodwill, development cost, all that what we are charged to the P&L, we will add it up. Deduct economic depreciation, not the book depreciation. Take the value of the asset as at today. And if we are going to take this asset today, what is the depreciation we will provide? Not what we have provided in the history. Today, if we take this asset is 2.5 million. And on this, we have to provide depreciation 10%, 250,000. Take the impairment. Because the goodwill we have added up, but take the impairment of the goodwill. That is an economic cost to the company. And then we arrive at net operating profit after tax. So we will look at some numbers in the question. So you just have to look at this slide and ensure that we can work out from the profit after tax into the net operating profit after tax. Determine the capital employed. There again, it is the economic capital. So we have to look at the replacement cost, all that, and adjust the capital employed. Look at the cost of capital, and then once we take that one, it's like RI, but we call it economic value added. The reason is we don't take the profit before tax, but we take something called net operating profit after tax, and then what we deduct is not the normal capital employed into cost of capital, but we deduct the economic cost of economic capital employed into the cost of capital. There are a couple of things. Accounting depreciation, this should be added always, and charge economic depreciation. Doubtful debts, it's a book entry, should be added. Non-cash expenses like depreciation, development costs should be added back. Interest paid net of tax. So because interest we pay say 100 million or 10 million, but since we are taking profit after tax, what should be added up is net of tax. So if the tax rate is 20%, 1 minus 0.2, 80% of the interest paid should be added back. Goodwill, any amortization, it's like depreciation, it should be added back. Development cost, whatever we are written off should be added, and capital employed also should be added, because development cost is according to IS 38, all research and development costs, unless it is something which we can capitalize, should be written off. But for the calculation of the NOPAT, we will add back. Leases, even operating leases should be added. You remember we had two types of leasing, finance leasing, operating leases. Normally in the P&L, operating leases we charge it to the P&L, but here we will add back that one and bring it as a capital investment. Economic depreciation. Depreciation is considered based on market values, not based on book values or historical values. So it's a complete change from our normal accounting. So it's most of the big companies, they do it, and it's a good thing to do it, because that will really tell us whether we are making profit or not. What are the advantages? Obviously, this is a good question that can come up in our paper. Basically, it measures the increase or decrease of company shareholders' wealth in terms of a division. It can be measured periodically. Book says fairly well understood, but my practical experience is not very well understood, particularly in this part of the world. Maybe in the Western part it's all right. People still don't understand this economic value concept, because we are too much driven into the historical figures. We are too much driven into the ROC. So it's not very working well. In international arena, There are a lot of seminars happening, lot of workshops happening. So the people who are more in the international thing, they will know. But in a smaller company in Sri Lanka, this economic value added is not very well understood, not very easy to explain to the board of directors. So in case studies, sometimes I have come across, um, they put this concept and they want us to explain it to a non-strong, non-financial directors, which is not very easy. But the Kaplan and most of the book says it is fairly well understood. I have a question mark all over whether it is understood. Economic value added is generally used to set target for performance of investment centers and also as a company as a whole. So remember, economic value added cannot be used for cost centers, cannot be used for revenue centers. It can be used only for investment centers. Even for profit centers, it cannot be used. Where the capital comes up, it can be used. So for the companies, it can be used. For individual divisions where it's an investment center, it can be used. So this is a short question you might get. It can be used to measure the real, actual economic performance. It can be used as a planning tool to make decisions to see how economic value is affected, because we are looking the current values. So we are comparing two companies or two divisions. One has which old assets, one has new assets. So when you compare under the old method, ROI method, the company which has new assets will show a poor performance because they are new assets, their profits will be low. But the old asset company, old asset division may show big performance because they are using old assets. But the moment you bring the economic value added concept, that distortion is completely gone. Whether it's old assets or new assets, it will be taken at the economic value. And then some of the underperforming divisions will be exposed to that one. And it's basically a long-term strategy which can be done. Will you give me a second, Dhanusha?
Yeah.
Hello? Mani Prishan? ඉන්නේ පහ ජූනි තියන්නේ නමුත් ඊට ඉස්සර දැන් අපි දෙන්න බෑ ඩිසිෂන් එක ඇත්තද මිනිහා නැද්ද දන්නේ නැනේ උදේට ගියත් බාගලාට ඉන්නවද කියලා බලා ගන්න පුළුවන් නේ හරි නෑ රට ගිහිල්ලා හරි කොහේ හරි දන්නේ නැහැ බාගලාට Okay, so this is a new tool. It's a new planning tool. It removes all the distortion. So, say for example, I remember in water sector, for example, there was certain new machinery or new plant to be introduced. So I remember at that time, the president of the country asked, what is the economic value added that is going to come up, which was very great. So she was thinking in terms of the new things that is going to come up, and replacing old, it's good, but will it bring anything additional value to the country? So that's what we should be looking in this measurement, I would say, all the time, but even it is not very easily understood by many people. This is why I say, if you are going to use economic value added, managers must be given proper training. Otherwise, they will go all over. They will not know anything about it. For a country, this is a very, very good tool to be used. We must look at whenever we do something in the country, what is it going to do for the economy? What is it going to do for the living standard of the people? We have to look at from that angle, and for that purpose, to get that kind of a brain into active working, we must get this people trained in that. They must be made aware of the interest cost, not only the interest cost, they must be made aware of the interest cost on the current economic values. You can have an old asset. How long can you go with the old asset? Don't you need to replace the asset? If you replace the asset, what is going to be your situation today? That kind of uh, brainwashing, or rather, I won't call it brainwashing, that kind of brain development need to be. With that, we have come to the end of that area, right? So, which is, so now we are finishing that one. The next area we have to look at is investment appraisal. So that's the next area we'll be looking at. So now in the areas that we have covered up, what I want is to go through all the areas that we have covered up. What is the textbook you are using, Danusha?
So the one you sent.
The BPP, no? Yeah. So keep reading now, because now we have covered up, I mean, almost half the area. So we have covered up activity-based, modern business costing techniques, and with this we have covered up the alternative measures of performance. Also, we have covered up transfer pricing. So we are now looking at the investment appraisal, advanced investment appraisal, collecting and using information. So just look at the areas what we have covered up, start reading, and if you have any difficulties, let me know. And we will cover up investment appraisal, advanced investment appraisal, and then we will look at some more questions later on. How is your calendar for next week? Monday is holiday.
Yes, but I'm not in
Okay, don't worry. Yeah, right.
So Tuesday, and I think I'm.
Tuesday, all right.
Tuesday should be.
Shall we make it Tuesday 10 o'clock?
Yeah.
Okay. So we'll keep the 2nd of May, 10 o'clock tentatively. Okay.
Okay, sir. Thank you.
So I'll see you on Tuesday 10 o'clock. Okay. Take care.
Bye.
Bye.